Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a topic that has been widely requested. And I just want to say before we get started, a big thank you to everyone that filled out the survey recently about our events and all the feedback that you guys have provided. We are incorporating a lot of that feedback as much as possible into our events. Looking at more advanced strategies and the different changes that we'll be making to these events going forward. You'll start to see them even starting this week. So in today's session, we're going to do an options strategy rapid fire session. A lot of people ask me for this. People ask for a cheat sheet of all the different option strategies that we typically look to trade and what are the best practices for each one. Instead of doing one session on each strategy, we're just going to do one session on all the strategies and give you a high level overview of every single popular option strategy, best practices for entering, best practice for exiting, but most importantly, so that you can gain confidence in your trading. Trading is scary. It's fearful sometimes, and it's hard to get a control of your emotions. So what we want to do is we want to show you the rules that can help put the probabilities in your favor and use these optimal strategies so that you can be confident when you're placing your trades that you're using the right strategies. So before we get started, what we are going to discuss today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the securities that we are going to discuss here in our session today. So all of the examples that we're giving is purely for educational purposes. So what I want to start off with today's session is talking a little bit about what you need to have in your corner to gain confidence in your trading, because all the strategies that we're going to talk about here are going to be useless if you don't first have a good framework as to how you can approach trading and be confident in it. So I want to discuss that first. Just things, what things are out of your control, what things are in your control, and learn how to control the things that are in your control. Then we'll talk a little bit about these optimal option strategies. I have 8 or 9 strategies lined up for you, best practices for each one so that you can have a cheat sheet across all of them. We're going to talk a little bit about adjustment and exit strategies on most of these strategies and kind of what you can do to decide when to get in, when to get out, and if you need to make an adjustment, what kind of adjustments that are required. And then I want to show you the income and opportunity reports that we have built here at OptionsPlay that allow you to take what you've learned, the strategies, the templates, the optimal strategies, and actually apply them to real trading. And then we're going to go through some real examples before we open this up for Q&A here at the very end. But before I get started, if everyone could please bring up your chat window at the bottom of your screen, I'm curious, how many of you are currently trading options? Please type 1 into the chat window if you're currently trading options. And please type 2 into the chat window if you're learning how to trade options and you're just getting started. Okay, so the vast majority of you are currently trading, but I see quite a few 2s and quite a few people who say that they're currently paper trading. Okay, so if you're an experienced options trader, we're going to go through some strategies that you're familiar with. Make sure that you understand your best practices for expiration dates, strike prices, the types of times that you want to utilize this strategy. And for those of you that respond to number 2, hopefully this is a good review so that as you trade any of these strategies for the first time, you're applying the best practices from the get-go. So let's first talk about building confidence in your trading. I tend to find that a lot of investors, trade on the back of fear, fear and greed. They kind of oscillate between fear and greed. When the markets are extremely strong, there's a fear of missing out. There's this FOMO, and you kind of get in because markets are up 10% and you don't want to miss out. So you get in near the top. And when you get in near the top, the market starts to crash down. And as it starts to get really bad, this is when the time that a lot of investors tend to bail, when actually those are the best times to buy. It's really kind of this contrarian thinking that we need to really have with trading rather than the emotional side of things. So this is the oscillation that I see a lot of investors kind of sit between of fear and greed. So how do you actually make sense of all of this? And this is something that you have to start understanding is that where the market is going is something that you do not have control over. If you're trying to control where the market is, you're going to have a very frustrating experience. However, there are a lot of things that are in your control, and you need to make sure that you actually control them in order to succeed in trading and build that confidence. And the first and foremost, the most important thing that you can control is position sizing. I cannot tell you enough how many times I have very experienced traders, professional traders, even members of OptionsPlay who will tell me, hey, I lost a lot of money on that last trade, or a trade that you told me to look at, I've lost a ton of money on that. And we always say, why did you lose a lot of money on that? And the answer is always because they traded too large of a size. No matter the rules that we put in place, we tend to find that a lot of investors don't necessarily stick to those rules. So make sure the next time you place a trade, you think about your position sizing and you think about, am I risking too much if this trade does not go in the direction that I expect it to? So position sizing is something that you have to absolutely control. If you don't control it, you're going to likely blow up your account. The next thing you have control over is strategy selection. And that's where we're going to spend about a lot of time here today, is understanding the different strategies and when you should use it. Now, within each strategy, how do you go about selecting expiration dates and strike prices? This is where you want to leverage the thousands and thousands of backtests that we have run across all these different strategies to understand how you can pick strike prices based on probabilities. And this is the important part, is you want to use a probability-based approach, a math-based approach to selecting your option strategies. If you want to have a particular edge in the markets, if you want to even have a chance at having an edge, you must use a probability-based approach. You can't just think today, maybe I'll use an at the money strike price. Maybe tomorrow I'll use an out of the money strike price. Today, I feel like using 5% out of the money. Tomorrow, I like to use 5% in the money. That's not a good approach to sustainable trading in the long run. So probability-based strike price is what we're going to talk heavily about here today. But really, one of the most important things for investors to understand is the relationship between probability and risk and reward. All option strategies is on this spectrum of probability and risk to reward. If you have a strategy with high probability, you're going to have low risk to reward. If you have a strategy with very high risk to reward, you're going to have low probability. And you have to understand the balance between and understand where you are on the spectrum. I see too many investors constantly ask me this very same question, especially from beginners. They'll ask me, how do I find high probability trades? And they're thinking, and I don't fault you for this type of thinking. The thinking is that if I just simply have more winners, if I can win 80% of the time, I'll be profitable in the long run. Well, guess what? That doesn't mean anything if you win 80% of the time. If the other 20% of the time that you don't win, you wipe out all of the gains from the other 80%. And that's trading. If you have a high probability, you're going to have very poor risk reward. So it's extremely important to understand the relationship between the two. But what really kind of separates, I think, successful traders from everyone else is really their ability to simply cut out their emotions and cut out their losing positions. I see a lot of investors asking me, how do I adjust a losing position back into a winner? First of all, there's no magic bullet. If there was, everyone would use it and no one would have any losers. It doesn't exist. The best thing you may be able to do with the losing position is to maybe reduce the amount of losses by a small amount, but that's it. But I tend to find most investors spend almost 80% of the time sweating it out, all these losers, kind of constantly watching their losers. Stop spending your emotional capital on losing positions. Cut your losers. Spend your time on your winners. Learn how to adjust your winners into bigger winners. That's how you're going to get ahead and become profitable in the long run. You're certainly not going to get profitable by turning a losing position, adding more risk to it, and potentially losing even more money. So cut your losers, adjust your winners. And lastly, trying to control your emotions, that is a bit of an oxymoron in terms of how you can do that. There's no one out there that's a robot. We're not robots, we're human beings. But what you can do is you can put up in place simple rules. The more simple your rules are, the more likely you're going to be able to stick to them and not have emotions come into play. The second way to control your emotions goes back to position sizing. If you trade 20%, if you risk 20% of your account on a single trade, guess what? That's going to be a very emotional trade, because if it doesn't go well, you're going to lose sleep over it. But if, let's say, you only risk 1%, 2% of your account per trade, even if that trade completely goes in the exact opposite direction that you expected to immediately after you entered the trade, just completely disaster of a trade, as people call it, disaster of a trade, you're still only risking 1 to 2% of your account. You're not going to lose any sleep over it. You're going to let that loser go and you move on to the next trade. That's how you get ahead, and that's how you gain confidence in your trading. Okay. Does that make sense, everyone? Before we even get into any strategies, please type 2 into the chat window if that makes sense to you. And this is by far the most important slide of everything that we're going to discuss here. Everything else we're going to discuss is really kind of the details, if you will. This is the high level stuff. This is what you need to focus your attention on, and making sure that you truly understand and grasp and embody in order to gain confidence in your trading. So once you have a sense for this, then we can start talking about option strategies. So we're going to go from beginner to advanced. We're going to start from the beginner strategies. We're going to move our way down. By far, the most simple option strategy is a cover call. This is where you can take profits on your equity positions while generating an income stream. A lot of investors think of covered calls as an income generating strategy. Don't think of it as an income generating strategy. Think of it as a way to take profits on the stocks that you own. And then you generate an income stream. The income stream that you generate from it is somewhat secondary to it. It's really nice to have. But the true goal of a cover call is to allow you to take profits when the stock has a strong rally over a short period of time. So when we talk about cover calls, we usually go out about 30 to 45 days to expiration, and we usually select a strike price that's a 10 to 15 delta. Let's talk a little bit about what 10 to 15 delta means for those of you that are unfamiliar. Delta is a probability-based approach to selecting strike prices. And the key here as to why we always use delta or a probability-based approach is so that we can get consistent results. So for example, if I choose a 15 delta call option, that means there is only a 15% chance that this particular stock, in this particular case, when I used Apple here, Apple's currently trading at around 147, and I sold the 160 cover calls. There's only about a 15% chance. As you can see, the probability of expiring worthless is 86%. That means there's only about a 14% chance that Apple will be above 160 by October 8th. So I'm selling the October 8th 160. So that's why I'm using a 10 to 15 delta, somewhere in that strike price range. Right now, I'm using about a 14 delta. And when you use a probability-based approach, that means 85% of the cover calls that I sell, the stock, I'm going to be able to keep the premium on it. Only 15% of the time is the stock going to make a very strong rally from $147 above $160, because the stock has to go above 160 for my stock to get called away. But I know, because when I use a delta-based approach, a probability-based approach, only 15% chance of that happening. The other 85% of the time I sell cover calls, I'm going to keep the premium. That's going to be my income stream. And that 15% of the chance, other 15% of the time, the stock is going to make a big rally from 147 to 116. That's almost a 10% rally in just about 45 days. That's a really nice return on my underlying asset that I own. And if that happens, I take profits. And in the meantime, when it doesn't happen, I collect that income stream. That is what a cover call is. Does that make sense? Please type 3 into the chat window if that makes sense to you. So we always choose cover calls that are far away from the current price. I see too many investors choose strike prices too close to the current price because they want that extra $1 in income. But what you do is, for that extra $1 in income, you might give up $5 or $10 in capital appreciation of your stock. And that is not a winning formula. So whenever you sell a cover call, use strike prices far away from the current price, 10 to 15 deltas. When you use the OptionsPlay platform, it is on your platform. And I'll actually show you the cover call report that we offer on the OptionsPlay Hub. Everyone that's a member here, you have access to the OptionsPlay Hub. Within the hub, there is a cover call and short put report. This actually scans the entire S&P 500 for you and finds you stocks that pay a high amount of premium for a cover call. So for example, if you own XPeng as a stock, you can sell the October 8th $45 calls to collect $1.75. That's 4.33% in just 43 days. And you can click on the link here on the right-hand side to actually show you the trade in OptionsPlay. This new feature is designed so that you can quickly take an idea from our opportunity reports and instantly review them using the OptionsPlay platform. So if you use OptionsPlay, when you click on modify, you can find the deltas actually on the strike drop-down menu, right? So for example, as you can see, there are three numbers. There's the strike price, the premium, and the delta. So we would choose either from the 49 or the 50 deltas, because as you can see, that's between 10 and 15 deltas, 11 and 13 deltas. So the 13 deltas, so there's a 13% chance that this stock will be above 49, and there's an 11% chance the stock will be above 50. So this is how you go about selecting your strike prices, but we actually do the work for you on this report. This way, you don't have to select the expiration date. You don't have to select the strike price. It does the work for you. You just simply go down the list, look for stocks that you own. So if let's say you own NEO and you want to sell some cover calls on it, it already selects the October $43 strike price for you and calculates for you the raw return in this particular case, which is 3.59%. And you can click on the link and instantly see the trade in OptionsPlay. But if you're using OptionsPlay, you can always use the strike price drop-down menu. You'll see the premium, the strike price, and the deltas on your OptionsPlay platform. So that's how you go about selecting cover calls. And some of the questions that I usually get around cover calls is, how do you manage them? So this is really where cover calls depends on whether or not you believe the stock is going to continue moving higher. So for most of the time that I sell cover calls, I'm okay having the stock being called away. But for some investors, maybe for you, you're thinking to yourself, I want to keep the stock. So if you need to roll a cover call, you never roll it early. You wait until the last 2 weeks before expiration, then you roll your cover call. But if the stock trades sideways, meaning it stays below your strike price, then you simply hold the trade until expiration. You can roll it at 21 days expiration if you want, but you don't need to. This is really it depends on preference and from investors, depending on whether or not you want to potentially have the stock called away or you don't. You might roll it but you don't have to. And if the stock declines after you sell a cover call, that's the only time you might roll a cover call early. And the rule of thumb here is when you can buy back a cover call for 20% of the original premium, that is time to start buying back your cover calls and rolling early. So those are the rules for selling cover calls. Let's now talk a little bit about selling a cash secured put. This is a strategy for if you want to buy a stock, how can you potentially acquire that stock at a discount? You sell a put option. It obligates you to buy 100 shares at a specific price in the future. And for that obligation that you take on, you get paid premium. So this is an October 144 put that obligates me to buy 100 shares of Apple at $144 on October 8th. And I'm getting paid $300 to do so. And if the stock stays above 144, I keep the $300. If the stock is below 144, I purchase the stock at an effective price of $141, because 144 minus 3 is $141. So I'm getting a fairly significant discount here. I'm getting a 2% discount on my stock purchase. So the rule of thumb for selling puts is about 30 to 45 days out, similar to cover calls, but you want to select strike prices that are very close to the current price. So a higher delta. Higher deltas means higher probability of the trade executing, if you will, or for the put option to be in the money. And what you want to do is you want to select strike prices close to the current price. Strikes close to the current price will help you maximize income, which will also allow you to maximize the chance of purchasing this stock. I know there was a question about what's POW. POW is the probability of expiring worthless, which is the inverse of that, right? So the probability of the price of the put being in the money is the inverse of the opposite of the put being out of the money. So a probability of expiring worthless is just the inverse of delta. So when you're selling a put option, choose strike prices close to the current price rather than like cover calls where you want to select strike price far away. And the options play cover call and short put reports are both available to you on the hub. So if you're thinking about buying some stocks, go down the list, look for stocks that you want to purchase. Maybe right now you think it's a great time to get into some of the electric vehicle stocks like XPeng. Then you can click on this here and take a look at selling a put here on some of the Chinese electric vehicle stocks. And as you can see, many of them are collecting a fair amount of premium. This XPeng trade here that I just pulled up gives me a 7% discount, a raw return of 7% in the next 43 days. So I can purchase the stock with a 7% discount if the stock is below $39. So imagine placing a limit order to buy 100 shares of this stock at 39 and getting paid $265 to do it. How much is $265 on 100 shares of XPeng? That is 6.5% of cash that you're taking up front just for the obligation to buy XPeng. And if the stock never reaches $39 and expires worthless, you keep the 6.5% and you can sell another put option, collect another 6.5%, and continue to take on this obligation until you purchase the stock that you want. And this is something that, you know, especially for a lower price stock, not suitable for Amazon, right? Because 100 shares of Amazon is, you know, $350,000 to sell a cash secured put. Not everyone has that, but to sell a contract here costs you $3,600. Certainly, perhaps in the realm for some investors, perhaps you, and you can collect $265 for that $3,600 that you need in order to buy 100 shares of this stock. And you're effectively buying the stock down here. Look at this. If you look at the historical chart, you're effectively buying it around right here by selling the put option here, as opposed to buying at the current price or even $39, which is here. So it's the difference between buying here versus here. Obviously, which one do you want to buy at? I think most investors will say they want to buy at the lower price. That's what a cash secured put allows you to do. And the options play, cash secured put and cover call reports allow you to find opportunities for both very, very quickly. Type in click on a link and be able to instantly view that trade within options play. Does that make sense for these two strategies? Please type 4 into the chat window if that makes sense to you. And whenever we talk about days to expiration, those are always calendar days. We never think about business days. I don't think anyone ever thinks in terms of business days. It's really difficult to calculate business days, always talking about calendar days. So now let's talk about more speculative strategies. Let's talk about buying calls and puts. This is just a strategy for when you have a strong directional view and you're expecting a quick and fast move. These are higher risk, but also higher potential return strategies. This is usually the first strategy you learn. It's not a particularly useful strategy in most cases because it's not every day that you think the stock is going to make a big move. It's actually fairly occasionally do you actually think that the stock is going to make a big move. Usually when the stock breaks out from a major resistance level or breaks down from a major support level, those are opportunities. Or maybe there's a catalyst like earnings. Those are another time that you might want to use a call or a put, but these are used fairly infrequently. But when you use it, there's quite a bit of variation in terms of how you want to select your expiration dates and strike prices. So for this, it's really about understanding the pros and cons about each one. One is not better than the other. All of them just have different pros and cons. So the shorter dated expirations will have faster time decay, but they also potentially have a higher gear leverage because you have gamma that works in your favor. So shorter dated options, if they move fast, can potentially give you a higher return, but they also have faster time decay. Longer dated options have slower time decay, but they have a smaller gear ratio. So as the trade goes in your favor, you're not going to see as much increase in leverage. So usually we tend to find somewhere between 30 to 60 days is a good starting point for these types of strategies. And then when it comes to strike prices, you can also choose a variety of deltas. And again, it's not about what's better. It's about what you believe the stock is going to do. The lower the deltas, the lower the risk, but also potentially the higher return. When you talk about a higher delta, we're talking about higher risk, but a higher probability of profit. So the strike prices just tell you the probability of profit. The higher deltas have a higher probability of profit. The lower deltas have a lower probability of profit. it's a lot to juggle, but this is really what you really have to learn and master before you can utilize the strategy. If you don't quite understand this yet, don't trade these. Paper trade them. Try out short dated options versus long dated options. Try out of the money options versus in the money options. Try all of them before you trade them. You really have to understand the relationship between these before you place the trade. That's the most important thing when you're buying a call or a put. Now, as you graduate to trading, as you become more experienced, I actually advocate most investors to look at vertical spreads. This is really where you can take the same directional trade that you're looking for with a long call or a put, but it's going to help you minimize risk and it's going to help you minimize time decay. So when we talk about a debit spread, this is usually where we go out 60 days. And what we do is we buy the 55 delta, which is just slightly in the money or just at the money price. So when Apple's at 147.5, we're buying the 145 calls. And then what we're doing is we're selling a 20 delta call against it. We're selling the 165 call. So we buy the 145 and we sell the 165. And what this does is it creates a break-even price that's much closer to the current price of the stock. Just to put that into comparison, when I buy a 145 call, this costs me $8.70. There's a break-even price of 153. The stock has to rally to 153.70 just for the strategy to break even. So I have to believe the stock is going to exceed 153.70 before this strategy is profitable. But if you look at the vertical spread here, the break-even price is only 151. So now the stock doesn't have to move as far in order for me to be profitable. So as long as the stock is above 151, I'll be profitable. So a debit spread reduces risk and reduces the break-even point and increases your probability of profit. And this is really where you start to get the best of both worlds. A lot of investors think about buying and selling options. Buying has its pros and cons. Selling has its pros and cons. When you trade a vertical spread, you kind of merge some of the pros and cons of the two, and you kind of get the best of both worlds. And that's really where debit spreads come into play. So whenever we're buying a call option or a debit spread, the rule of thumb for managing these are pretty simple. There's only two possible signals to exit. Whether you're buying a call or a put or a debit spread, whatever you pay for that debit spread or call or put, that's the most you can lose. So whenever you lose about 50% of the max loss, that's usually a good sign that the trade has not worked out. It's time for you to cut your losses, keep the other 50% that you still have remaining and apply it to the next trade rather than holding on to that trade, hoping that the trade comes back. The second rule of thumb is as the trade starts to profit at about 75 to 100% profit, that's when it's time to start taking profits. Now, this is really where you start to think about adjusting your trade. Do you take your profits and simply want to buy more of that call option or new call options because perhaps the stock went from 145, maybe the stock went from 145 to 155. So you bought the debit spread and it got up to the target price, but now it's at 155. You're thinking to yourself, maybe this could get to 165 or 160, right? So what you can do is you can turn the profits from your first winner into the trade for the next trade without actually risking any more capital, because now you're taking the profits to apply to that second trade. Those are the adjustments. Those are the roles that you want to focus your attention on and focus your emotional capital on. I see too many investors when they buy an option and the stock goes down to 140, they do all types of things hoping that the stock gets back up. They pray, they buy more options, they do other things, they make adjustments. And what they do is they spend so much time watching this trade that has gone south, hoping that they're going to get back. And it just never quite gets there. And sometimes they even lose more money. That's not where you want to spend your time. Does that make sense? Please type 5 into the chat window if that makes sense to you. And again, the deltas, they're on the platform. When you select your strike prices, the delta is next to the strike price so that you can choose your strike prices. The next strategy I want to talk about is a short credit vertical spread. This is a strategy that we trade very often because it's a very forgiving strategy. It's a strategy that you can find opportunities all the time in this particular strategy. So it's a strategy that's a relatively forgiving directional strategy, meaning you can kind of get the directional view right or kind of get the directional view wrong and still be profitable. It is a strategy that has positive time decay. So the longer you hold on to the trade, the more premium that you're collecting instead of premium that you're paying. But in exchange for all of that, you have negative risk to reward, which means that for every dollar you can potentially make, on the back of that, you're usually risking $2 or sometimes even a little bit more than that. So for credit spreads, rule of thumb here is 45 days to expiration. What you want to do is you want to sell the at the money strike and you want to buy a 25 delta call or put. So when Apple's trading just shy of 148, what we're doing is we're selling the 148 put and then we're buying the 140 put, which is roughly the 25 delta. The rule of thumb for this particular trade is that you must collect 1/3 of the distance between the two strike prices. So the distance between these two strike prices is 140 and 148. That's $8. And what we're collecting here is $2.70. Right? So $2.70, we'll do a little bit of quick math here. 270 divided by $8 is 33.75%. So this one just ekes in the minimum, right? Usually we want to try to find more premium. And we actually have a credit spread report that actually finds credit spreads that have higher premiums. And this is really where you can access our credit spread opportunity report on our hub. When you click on the credit spread opportunity report, actually, I already have it open here. What we search for are credit spreads that collect more than 1/3 of the width. And for those of you that want to learn more about this strategy, the more you collect, the more edge that you have, because whatever you collect in income, the rest of it is going to be your risk. So the more income you collect, the less risk you take. And this is really the secret, if you will, to finding option strategies that are most profitable. And when we talk about, like, for example, Kraft Heinz is currently trading at 36. When we sell the 36.34, that's a $2 wide credit spread. We're collecting 75 cents. That is 37% of the width here. So this is really where you can click on a trade and instantly see a particular trade that collects a fair amount of premium and works in your favor. And this is really where this is the contrarian nature of trading, right? A lot of investors will ask me, why would you sell a put credit spread, which is a bullish strategy, on a stock that's so clearly bearish? Well, this is the contrarian nature of trading, right? Do you want to buy up here or do you want to buy at the bottom, right? So think about a stock, right? Do you want to be the buyer up here or do you want to potentially be the buyer down here? And that's a contrarian, right? Because when things are going well, when things are trending up, this is usually tends to where we see a lot of greed, where this is actually the best time to sell, and vice versa. When the stock has declined, this is usually perhaps a better time to buy. This is not to say that we know for a fact Kraft Heinz is going to bounce, but statistically speaking, when stocks are oversold, they have a higher probability of bouncing than when the stock is all the way up here. The statistics of it continuing is less than for the statistics to bounce. So it's all about putting probabilities in our favor and continuing to place trades that we know are putting the math and probabilities in our favor. Ultimately, no one knows where the markets are going to go. Stop trying to predict where the market's going to go. We can make inferences. We can try to predict, but at the end of the day, when the trade doesn't go in the direction that we expect it to, don't beat yourself up, because it's not something you have control over. You can only put the probability and statistics in your favor. So that's how you want to think about credit spreads. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. Okay, we're getting through a lot of strategies now. We're really getting to some of the more advanced strategies. But before we do, we'll talk a little bit about managing credit spreads, because this is really where it gets a little bit more tricky. Whenever you were collecting premium, it gets a little bit more, I would say, complicated than when we're paying for premium. Whenever we're paying for premium, the rules are simple. You lose 50%, you get out of the trade. You make about 75 to 100, you start taking profits, and you can start rolling them into new trades and start keeping those profits going. But when you're collecting premium, there's a little bit more involved. There are 3 possible triggers to exit a credit spread. When you've made 50% of the max gain, that's time to take profits. When you've lost 100% of the max gain, that's when it's time to cut your losses. And if you reach 21 days to expiration and it doesn't trigger your stop loss or your take profit, it's also time to get out of the trade. So for example, if you sell a credit spread for $2, if you sold something for $2 and it's now trading for $1, you've made a profit of $1. That's half of the max profit. That's 50% of the max gain. It's time to take your profits. If you sold something for $2, but instead it rises to $4, that's a loss of $2, which is 100% of the max gain. It's time to cut your losses and get out of the trade. And if it hits 21 days to expiration, where the spread does not decline to $2 or does not increase to $4, it's also time to get out of the trade. I don't have quite enough time today to really get into the details of that, but those are the rules. It's a little bit more involved, but those are the rules for managing a credit spread. Now let's start talking a little about calendar spreads. This is really where we start to meld some of the different things that we've learned. We've learned about buying calls. We've learned about selling cover calls. A calendar spread is kind of like buying a call and selling a cover call at the same time. And what you're doing is these are neutral strategies with limited risk. It's similar risk profile to shorting a straddle, because if you look at this particular risk profile, as you can see, it's very similar to selling a straddle, but it has limited risk. Selling a straddle has unlimited risk. Trading a calendar, trading a diagonal, these have limited risk. That's one of the benefits of these types of strategies. The rule of thumb here is that you usually want to buy about 3 to 6 months out the long option that you're buying. So if you have a long-term bullish view or long-term bearish view, you want to buy a 3-month call or a 3-month put. And then you want to sell short-dated options against it. You want to sell, let's say, a 1-month call or a put against it. Here I'm buying a December 150 call and then selling a September 152.5 call against it. So I'm buying a call option, a long-term I'm bullish, and short-term I'm selling some short-term calls against it. And you usually want to buy about a 50 delta and sell about a 35 delta or so on a diagonal. Or if you're trading a calendar, you might want to use a 30 to 40 delta here on a calendar spread. But the rule of thumb here, whenever you're trading any type of time spread, you're trading a calendar, you're trading a diagonal, the major rule of thumb here is that the front month vol, the month that you're selling, should always be higher than the back month vol. So the volatility, implied volatility option that you're buying should always be on the lower end, and the implied volatility option that you're selling should always be on the higher end. That's how you're going to help bring down the cost of the trade. You're basically selling something that's very expensive and buying something that's relatively cheap. Now, I also have a new video just on this strategy alone. So if you want to learn more, I highly recommend that you take a look at my calendar and diagonal option and video. And remember, because these are debit trades, you're paying money to enter these trades. The rule of thumb here is very similar to buying a call or a put or buying a debit spread in terms of when do you cut your losses and when do you take profits. Next, I want to talk a little bit about butterflies. Now, this is where we start to get into more advanced strategies. Butterflies is really kind of it's kind of like playing roulette a little. It's very low probability, but very high risk to reward strategy. And we tend to find that when we're trading butterflies, this is really where we go out about 30 days to expiration, 28, 30 days. This is usually the sweet spot when it comes to butterflies. And this is really where I think a lot of investors tend to use butterflies incorrectly. A lot of the times, investors use butterflies as a neutral strategy, but you really should not use butterflies as a neutral strategy. They should be a bullish strategy or a bear strategy, where you want to basically take a very low amount of risk, and you know that the probability of it is relatively low, but if it does happen to make the move that you expect it to, that you are able to have a very strong risk to reward. So for example, Apple's trading at 147. Right? If I was to bet that Apple was going to go up to, let's say, 155, about a $7 move. If I bought a call option, it would cost me about $8. So even if the stock moved $8 higher, I basically didn't make any money, right? Because the amount that the stock moved by is what I paid for that call option. So a strategy that you can use is a butterfly, because a butterfly, you should always use the strike price of the short, you're basically selling a straddle, because when you think about a butterfly, what you're doing is you're selling a straddle. And then what you're doing is you're buying an out of the money call and buying an out of the money put and reducing the risk of the straddle. So where do you want to sell the straddle? You want to sell the straddle that's roughly the expected move, meaning the question is, you make the most profits when the stock is at exactly the tip of the straddle. So the question is, where should you sell that straddle? And if you look at the implied moves of an option, that gives you probability based where if the directional view that you expect it to is right, how much the stock is going to move. So that's why when you think about a butterfly, you want to sell the tip of the butterfly at where the probability tells you it's going to be. And that's where the strike prices that you should use on a butterfly, which is usually about a 16 delta. 16 delta is one standard deviation of the bell curve. So that's where I chose the 155 butterfly, because the implied volatility option is telling me that if Apple was to move higher or lower, it should move up by about $8. And that's why the call option cost about $8. So, and when you do get it right, and it's not every time you're going to get it right, but if you do get it right, you can potentially have roughly about a 5-to-1 risk reward ratio. Here, I'm risking just $79 to potentially make $421, but I'm only going to make $421 if Apple lands at exactly $155. If it lands at $153, I'm probably going to make half of that. If it overshoots at $157, I'm only going to make about half of that, right? So you quickly get away from that $420. You have to get it exactly right. So use the option premiums to your advantage, because the option markets usually are pretty good at pricing how big of a stock, how much the stock can move by the expiration date. And that's how you can use, probability-based approach to selling, to trading an iron butterfly. Lastly, actually two more strategies, iron condor. This is where you would typically call a purely neutral strategy. This is a strategy with limited risk and generally used for high implied volatility environments where you think the stock is largely going to stay where it is. You don't think the stock is going to make a big move. If you make a big move, you'll see a loss. If the stock doesn't move very much, you'll see a gain. Generally speaking, 45 days to expiration for a iron condor. What you want to do is you want to sell a 25 delta strangle. So what you're doing is you're selling a 25 delta put, and then you're selling a 25 delta call. And then what you're doing is you're buying a further out of the money call or further out of the money put in conjunction with that to offset the risk. Those are what we call the wingspans. And usually want to buy a wingspan that's about $5 to $15 away from the strike prices that you've sold. This is a more complicated strategy. It's one that I don't particularly love trading, but it is something that some investors like to trade because it's really just a call credit spread and a put credit spread combined into a single strategy. We call it an iron condor. And there's really not a whole lot of tricks to trading this. You have the same rough rule of thumb for selling an iron condor is you want to take profits at about 50%. And as the stock moves in a particular direction, what you can do is you can roll the untested side. So for example, if the Apple starts to rise, what you can do is you can roll the short strikes up. As long as you maintain the same distance between the two strike prices, it doesn't cost you any more money or any more in maintenance, margin requirements, and you're going to be able to collect more premium. So you effectively can turn an iron condor into an iron butterfly. So basically, when I move the two strike prices over, the put side, I basically turn an iron condor because one side stays and I'm moving the other side. When I move one side to the other, it turns it from an iron condor into an iron butterfly. And by moving the strike prices, I'm going to collect a little bit more premium, usually not enough to offset the losses, but it certainly reduces the losses on an iron condor. This is more complicated. I don't quite have enough time to get through all of it, but that's at a high level how you think about an iron condor and adjusting it. And lastly, we'll talk about a short straddle and a short strangle. These are the two strategies that truly have unlimited risk. You have to understand what that means when you're trading it. If you shorted a strangle or if you shorted a straddle on a stock like GameStop or AMC, the higher the stock goes, the more you lose. There's no limit as to how much you can lose. So be very careful with this. But it is a strategy with a very high probability of profit. It truly has unlimited risk, and it is good for when you have a high implied volatility and a neutral outlook on the stock. But again, remember, this has unlimited risk. 45 days to expiration, generally speaking, is what you use for a straddle or a strangle. When you're selling a straddle, you simply find the at the money call or a put. That's what you sell. If you're selling a strangle, you use about a 35 delta call and a put to sell. So for example, if I go out to November and I'm selling the 135, 160, that is going to give me a break-even point between 129 and 165. So as long as the stock does not exceed 165 or does not go below 129, I'm going to be profitable on this trade. That's a pretty wide range that Apple can trade in between now and November. And as long as it does, I'm profitable. And even if it exceeds it by a little bit, even if it goes to 170, I'm only losing about $500 on that, and I'm collecting $579 on this. So you have some leeway on this. The stock really has to make an pretty sizable move beyond your strike prices before these strategies will become unprofitable. So generally speaking, the rule of thumb here is avoid selling them going into earnings. And you can also adjust the untested side. The same way you can turn a iron condor into a butterfly, you can turn a strangle into a straddle by moving one side, right? So if the stock starts to drift higher, you can move the put side higher. If the stock starts to drift lower, you can move the call side lower. And you basically turn a strangle into ultimately a straddle. Those are some of the ways that you can trade these and adjust these. And we also have a straddle report as well. The straddle report you can find on the OptionsPlay hub using the at the money straddle report, which is the at the money straddle report. It tells you the stock, the price of the stock, the straddle to sell, and how much premium you're going to collect. And we also show you the premium as a percentage of the stock price. So for example, if you sold the Gap $26 straddle, you'll collect $3.83. On a $26 stock, that's 15% of the stock's value that you're collecting in about 45 days. Now, Gap reports earnings here, so perhaps not the best example here, but let's look at PDD, $95 stock. If I sold the $96 put, I'm collecting $13.63. That's 14% of the stock's value. This doesn't report earnings for another 77 days. Usually when you're selling at the money straddles, you don't want to sell going into earnings. So you want to make sure you use the earnings flag data to find straddles and strangles that do not have earnings coming up between now and the expiration date. So that covers what I wanted to share with you here today. I hope that this was helpful in giving you a full overview of the broad option strategies that you can trade, the best practices for each one. We are going to send you these slides so that you have these as a reference. You can print them out, you can put them on your desk. So every time you place a trade, you can reference these. But more importantly, the strategy reports that we have already apply all of these best practices for you, whether you're selling cover calls or cash secured puts, whether you're selling credit spreads, whether you're looking at straddles and strangles. This is all already filtered for you with specific expiration dates, strike prices, and the analytics that you need to determine whether it's a trade that you want to make in your portfolio. And you simply click on a trade, it'll instantly open the trade in OptionsPlay so that you can analyze the trade before you execute, send it off for execution. So with that, thank you so much for your time this afternoon. What I'll do is I'll open this up for Q&A. If anyone has any questions, please type your questions into the Q&A section. There's a chat window and a Q&A section. Please, I'm requesting that you type your questions into the Q&A section, and I'll try to answer your questions through the Q&A section. Would you ever sell a credit spread that expires in 10 days or less? So William, you can, but there's a high amount of gamma risk involved, and there's a high amount of expiration and assignment risk. So you're taking on additional risk to do so. So what you get is you get faster time decay, right? You certainly get that when you're doing short dated options, but you get acceleration and gamma risk, and you get a much higher risk of assignment and exercise risk. So for those reasons, that's why we don't do that. You can if you want to, if you understand the risks and you're willing to take those risks. But we tend to find that most people who sell credit spreads do not want to be assigned. They'll actually do everything they can to avoid assignment. And the best way to do that is to sell at 45 and buy back at 21. If you follow those rules, you will almost never be assigned early on a credit spread. Jean is asking, the premise between selling the 50 delta and buying the 25 delta in the credit spread is based on risk to reward. Adding technical analysis to that, wouldn't it increase your chances of being profitable? It absolutely will be. I would say, especially when you use statistics to try to add, find trades that statistically have a higher chance of a bounce. But your question is, if it went a little bit, wouldn't it increase your chance of profitable if you went a little bit out of the money and get better pop over time? So if you went out of the money, you wouldn't get better pop. You would get you would get better pop and you would get less than 1/3 of the width, as long as you get 1/3 of the width. So yeah, I think that, if you want to make those minor adjustments and you think you can be profitable with it, by all means. This is a good starting point. This is not to say this is the only possible way to trade. I generally set price targets for my debit spread. Sometimes price gets close, but then it fails to go all the way. What rules could I use to take some profits when I get close so I don't lose the whole trade? So if you're trading multiple contracts, you can always scale in and out of these trades, right? So usually at 50%, you can start taking some profits, but usually you want to try to leave at least half the position to strive for that 75 to 100% gain on a debit spread. But you can always take half the position at 50%. Wayne is saying, Tony, selling a naked put has max risk of the stock going to zero. So what percentage of the max risk or max gain should I use to cut my losses to close the trade? Wayne, I usually don't advocate selling naked puts. First of all, what are your chances of it going to zero by the expiration date? Remember, it not only has to go to zero, it has to go to zero by the expiration date. Those are two very different things, right? I usually don't think that those probabilities are very high. But if you really are trying to cut your losses, then just buy a really far out of the money put to offset your risks, to kind of prevent that black swan event, if you will. What are your thoughts on broken wing butterflies? Broken wing butterflies are just as suitable as regular butterflies, but it follows the exact same rules as I said before. Broken wing butterfly just prevents you from losing money when you overshoot the move, right? So yeah, you absolutely can. It's a small adjustment that you're making. It lowers the risk reward on the trade, right? From about 5 to 1 to probably closer to about 3 to 1 usually on a broken wing butterfly, but it does prevent you from losing money if the stock overshoots, your directional move. How much is your membership? Membership is $100 a month or $750 a year. Is it time to exit CVS? I don't believe so. When I looked at CVS early today, I do not believe it's time to exit, and certainly is not near our stop loss levels either. Alexander, fantastic overview. I believe that you said that the bid-ask spreads are wider after hours and on weekends. Why is that? Well, market makers are trying to protect themselves going into the close. They don't want an order coming in at the very last moment where they don't have enough time to hedge their positions afterwards. So they widen out their spreads to protect themselves from, sometimes we see some events that happen right before the close and maybe some other market maker is faster than them, or maybe some high frequency hedge fund is faster than them and just take out a whole side of the market. There's a whole video that I've done here on market maker, how market making works and the risks that they're really taking to put on those quotes out there for you. But they widen them out to protect themselves at the end of the day so that they don't get stuck in a position that they can't hedge overnight or over a weekend. What is your go-to strategy for earnings? So Alex, I would say that my predominant strategies is usually either debit spread or a credit spread. On credit spreads, when I don't think the stock's going to make a big move and I want to take advantage of volatility crush, and debit spreads when I think the stock is going to make a big move. Salesforce is an example of that. We made an earnings play on Salesforce. My expectation was that the stock's going to make a big move. That's why we traded a debit spread. Mike traded an Advanced Auto Parts last week on a trade that, he didn't think was going to move as much. And I agreed with him. Selling that put credit spread was a better way to go. Is there a video that you have to cover the Greeks? Yes, I do have a video. You can find it on our YouTube channel. Please explain the difference between a straddle and a strangle. Very similar strategies, just one, a straddle is the same strike price. So for example, Penn National Gaming trading at $80, I would sell an $80 strike. So an $80 call and an $80 put, that's a straddle. When we talk about a strangle, this is really maybe where I sell the $75 put and maybe I sell the $85 call. So two separate strike prices. That's the difference. One collects, as you can see, $13.40 and one collects $9.15. The one with the $9.15 has a wider bid break even. This has a narrower break even. So you're going to collect more with the lower chance probability of making profit. Here you collect more with a lower probability of profit. Rotimi, it is $100 a month or $750 a year. Should we apply the same strategies for commodity options? So from an options pricing perspective, commodity options is no different from an equity options. Directionally, they're going to be a little different, but I don't believe that you would change anything if you're trading commodity options. Can you explain in detail the pop on your credit and debit spreads? I'm not sure what you mean by explain the pop in detail. Pop is just simply calculated based on break-even points. So it doesn't matter whether you're trading a debit spread, a credit spread, call put, it doesn't matter. All it matters is your break-even price of the strategy and the probability of the stock being above or below that break-even price. That's how we calculate pop. Can you explain again what gamma risk means? Gamma is what changes delta as the stock goes higher or lower. And when you're far away from expiration, gamma is relatively low. So delta moves in a fairly steady pace. But as you get closer and closer to expiration, your stock can either be in the money or out of the money with just a small move. So that's where gamma is extremely high, meaning even a small move will drastically increase the leverage on an option or drastically decrease the leverage on an option. So gamma increases as you get closer and closer to expiration, and technically approaches infinity at expiration. So what you want to do as a short option trader is you want to avoid gamma risk, because gamma's risk is the one that goes against you, right? If the trade goes in your, as you get closer and closer to expiration, even a few pennies move in the underlying stock can turn a strategy from fully profitable to a losing trade. So that's what you generally want to avoid when you're selling options. Is there any early assignment risk if the option you're short is out of the money? You have less risk with an out of the money option. I would say that generally speaking, the out of the money options have very little risk. If not, do you really need to close the spread 21 days before expiration? So Daniel, this is really where, again, you don't have to, but we've seen, and the chances of this happening to you are so low, but we have seen it over and over again over the years where a stock just makes a big move after the close on Friday. You think the stock is closing out of the money, but some news comes out after the close on Friday. The latest one that I remember here is a couple of stocks reported earnings on Fridays. Nike did this year. Rare for big cap stocks like Nike to report on Fridays, but it did. And a lot of options that expired out of the money became in the money after the close. And you don't have an option at that point because you can't close a short option after the close, right? Another one, Biogen. Biogen had an FDA, the market thought the FDA was going to approve one of their drugs. On Friday's close, after the close, the FDA came out and said they're not going to approve it. The stock dropped about $100, and a bunch of options that puts that expired out of the money, $30, $40 out of the money, were $60, $70 in the money by Monday morning. So the chance of that happening, relatively low, but best practice to close out your spreads, just in case you don't wake up the next day or on Monday morning with a few $100,000 loss because you didn't consider that. I have many debit spreads that never hit 75 to 100, but do hit 20 to 50% profit before reversing direction and ending up even or losers. What should I do to prevent that from happening? So you should revisit your strike prices for that debit spread. If you're reaching 20 to 50% and never hitting that 75, 100%, that means that you're probably choosing strike prices that are pretty far out of the money. So revisit your strike prices, buying slightly in the money, selling a 20 delta usually is a good starting point. As long as you have a strong directional view. And the other thing that you have to think about is, when are you using debit spreads? Remember, debit spreads should be used fairly sparingly. Debit spreads are only for when you see the stock is broken out from a major support level or major resistance level. So for example, CRM, Salesforce, that we recently just took a bullish view on here. Why did we take a bullish view here on CRM? It's because the stock has recently broken out from a major resistance level. This was a resistance level that had been in place for multiple months, and it started to break out here. My expectation was that we're going to get a big move. It's not every day that you get big moves on stocks. So think about when you're using debit spreads. You should only be using debit spreads when you expect the stock is going to make a big and fast move. I had a catalyst event for Salesforce, and I thought the stock was going to make a big move. That is a good time to start using debit spreads. You should not use debit spreads every time you think the stock is maybe going to drift higher here. You're better off selling credit spreads. So if you find yourself in that position, Richard, I think that you might want to think about whether you should be using debit spreads or perhaps you should be using credit spreads more often. Can you comment on reverse strategy? What's a reverse strategy? Selling an out-of-the-money put to finance an out-of-the-money call or debit spread. So that's what we call either a risk reversal or a call spread risk reversal. It's a strategy that's really interesting for investors who are not afraid of owning the stock. So you're basically, let's say, buying the 260, 290 call, and then at the same time you sell, let's say, a 240 put against it. You have this particular outcome. It's not for everyone. It's kind of like selling in the money put, if you will, in terms of the way that the trade, the structure works. So for example, if you sold a 290 put, as you can see, the two strategies are going to be 290 put. As you can see, these two strategies are quite similar to each other. The only difference here is that you have this little plateau, if you will, before it starts to drop off. That's the only difference between the two. It's an interesting strategy. If you don't mind owning more stock, it allows you to basically buy a call spread with the break-even price. It's very close to the current price. As you can see, 267.79. The stock only has to move about $2 higher in order for that strategy to be profitable. It's a more advanced strategy, but if you're okay with selling a put and buying a call spread at the same time, it might be one that you might want to take a look at. Okay, with that covers the questions that I have time for here today. Thank you so much for your time. I hope that this was helpful in giving you a better understanding of just a review of all the strategies. I get this question a lot about asking for cheat sheets. So hopefully this gives that to you. I'll send you the slides along with the recording so you can follow along at your own pace. Print out the slides as your cheat sheet and use it the next time you place one of these trades. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week on our Tuesday morning market outlook session. And we will be sending you a chart book tomorrow morning to help you stay on top of everything that's moving in the markets tomorrow at about 9 a.m. So with that, thank you so much and have a great night.